crash really come to Calgary? Well, it's Darren Langille once again back with another Calgary and area market update. Today, we're going to highlight what you need to know about the month of September. Hint, it's certainly not all roses, but it's not littered with thorns either. So let's dig in, and please make sure to stay right to the very end on this one. Now, in times of uncertainty, and as more time passes with continued inflation talk, tax hikes like the other day, House of Commons motion, interest rate hikes, and overall price crash concerns in the media, my experience shows me that there are two camps of people forming. Now, the camp that takes the information in, makes adjustment, but then continues to push forward with some altered life plans. And then there's those that take the information in, but end up in sort of a paralysis mode, unable to decide what actions they should take. Now, as you hear this, it may sound like I'm being a little harsh, but I'd suggest maybe you ponder that just for a second and take stock on which camp you've been finding yourself in lately. I say this because as a realtor, well, we don't help people buy and sell houses. We actually help people as they undergo their biggest life changes. So people's ability to undergo these changes are certainly impacted by the external elements happening around them. But paralysis or inaction, well, is never nearly in the best interest as life continues to push us on. Things like babies are entering the family for the first time, parents downsizing to something more manageable. Maybe you're moving cities or provinces and just getting your first job. Maybe you're bringing family members from other countries or continents to live safely with you. See, it's with the weight of this message that I come to you humbly today, and I hope to continue shedding light on the most accurate reality that I can kind of paint here in Greater Calgary. So let's get into the nitty-gritty, shall we? The end of September marks something interesting I wanted you to take note of. It's now been one full quarter, or say 90 plus days, that Canadians have been dealing with the interest rates that are at or above a full 2 percentage points above what we've been having for years. So in other words, we've now undergone a complete cycle of buyers and sellers who got into the game and made a move post rate bumps and post peak pricing to hit our city. See, this group of people made a move without the benefits of the ultra low rates that we had before, and now are experiencing those 15 to 20% price increase price points. Essentially, this group of buyers and sellers were only exposed to our new normal. Higher prices than ever, and rates now up around those historical norms. This is the group for which our recent stats are speaking to, and in my opinion, they give us a pretty clear picture of what's actually going on out there. So let's start, as we oftentimes do, with the sales summary. Point blank. Well, sales, they are down right now. Stats show around 12% less were sold in September than last year's September. This is also an 11% drop just from August, which is now, if you're wondering, about a 50% sales drop in numbers from our peak in March. But beyond that, I should share two key points. March was 30 to 40% higher than what we'd ever expect at that time of year. So that negative comparison that is being made is kind of foolish in its use. Secondly, when comparing to last September, it was also a record high September in that post-COVID, high pent-up demand and ultra-low interest rate environment. Also kind of a foolish for us to talk about and compare against. Historically, when it's just the data being considered, this September's total sales number will go down again in the history books in around the top 5. Pretty good, all things considered, I'd say. However, things are continuing to shape up quite differently across those 4 various property types. I'll spend a lot of today's update bringing light to some of that. So detached and semi-detached homes are where we're seeing the main slowdowns, 23% and 27% respectively, less than last year. With detached being kind of our largest sector, its 23% reduction is what's dragged down that overall sales stat. See, reduced affordability from rate hikes brings less sales in single-family homes in general. This is now starting to show up in that 600 to 1 million price range, as things are taking a little longer to sell, and we're seeing just a little bump in active inventory too, adding to its general slowdown. Now, the single-family home values below this, they're hard to find, and they're selling fast. The stuff above above $1 million doesn't seem to be phased at all, and they're continuing to sell at about the same pace as last year. Now, where affordability is concerned, the apartment sales pace continues to drive forward with lots of momentum. To put it into perspective, September had more apartment sales this month than in any particular month of 2021. And if you remember 2021, it was really a fantastic overall real estate market. Now, along with it, our row home market, our second most affordable market, is near even pace with last year. And that again is saying something because how strong the row house segment was then too. All right, let's continue to round out this message with our inventory story. With sales slowing as a whole, what is happening here in the inventory story is critically important. And if you've been following any of my updates for the last 18 months to 2 years, you'll be very familiar with this message. The number of active properties on the market is low, low, low. Regardless of sales slowing and concern for affordability, we are in that record low active inventory position. Simply put, not a lot of new homes coming to market and not a lot of overall homes to look at. Now, there are a few sub-stories though. In regards to the detached, where it's slowed the most overall, as of October 3rd, when I wrote this, there were 453 single-family homes on that market, under 500K. And in the month of September, there was 283 sales. That's only a month of supply of 1.6. Good sales, low inventory, tight market. Now looking 600 to 1 million, as mentioned earlier, it looks a little like this. 331 single-family homes have sold in the last 30 days, and we currently have 930 on the market. Now this is 2.8 months of supply. This is balanced territory, not seller's market. So we need to be absolutely dialed in when making real estate decisions today. Pretty please ensure you're getting tactical and relevant advice from your trusted real estate advisor. Now, one extra thing about inventory. The active number of homes on the market for semi-detached, row homes, and apartments are between 26 to 34% less than this time last year. It's a lot. That's a combined 900 less properties on the market to look and buy if you're in that segment. Again, so the more affordable the market, the tighter it is. And then as we creep up in prices, well, so does inventory just a little bit. So what do you think this does to our ability to fight off the crash? Well, I'd have to say it's a pretty strong case. Okay, let's finish off with everybody's favorite, the pricing picture. This is one of the things that gets the most headlines, the most comments on my YouTube, and most mixed messages. So I'll do my best to provide kind of as much context as I can. I like to look at things a few different ways here. Number one is how we're doing since last year at the same time. And then how have we done among the last full quarter of buying and selling cycle that I spoke about. So let's start with the year-over-year figures. So as a whole, despite the changes since the interest rate bumps, we remain between 10 to 15% higher in terms of our benchmark sale price than we were at this same time last year. It's huge. It's a huge win on all fronts, especially after everything that's been thrown our way. Some may want to chime in here and say, well, what's happened since peak? But I would suggest, why does this even matter? Because unless you're a flipper or you've had a financial hardship since being a buyer at the peak, real estate is a longer play for literally everyone else, and the trend matters over years and years and years, not the last few months. Now that being said, if you really wanted to know, as a whole, we're down 3.4%, which is on average about $18,000. Specifically though, the number is greatly different from the greater satellite communities all the way to the heart of our city and all the various districts. We see price growth as low as a few percent and all the way up to over 20%. So again, the message is be careful about the information you hear and then take action on it. Now the second point I wanted to make was in regards to our most recent buying cycle, the last 90 to 120 days, since rates skyrocketed and affordability started to plummet as a result. Detached prices we'll start with. Was 647 to 628, that's 2.9% decline. Semis was 581, went to 562, that's a 2.2% decline. Row homes, 364 to 362, that's basically flat. And apartments, 277 to 278, again, basically flat. To me, this last little bit of information tells a really full story to truly, well, how is the market? Because it's buyers and sellers that have come to market under the current status quo of uncertainty, rising rates, inflation spiking, and all doing so among the quieter time of the seasonal sales cycle. So from here, nobody really knows what will happen, as we likely get another rate bump in October. But so far, with a more than 2% increase, we've already showed prices here in Calgary to be pretty resilient so far. Now, most importantly to this whole update, I have one more thing to sound off on. And I hate to sound like a broken record, but here it remains very important for us in Alberta to know these things, and specifically Calgary, to continue to look at the macro elements positively affecting our economy and thus our real estate. We had just the highest net migration to Alberta ever. Yes, ever. Take a look at this recent 5-year graph. Look at the massive influx of citizens to our province. It's amazing. Okay, then look at this one, spanning out prior to the double-digit price run of 2004 to 2007, when Alberta was kicking on all cylinders. We brought nearly 10 and 15,000 more people to the province this quarter from one of the best quarters of all time. Then now you go all the way back even farther to the graph showing growth prior to the 80s. The big boom that we experienced prior to that other Trudeau screw-ups still didn't hold weight to our most recent quarter. Just look at how high we are now. So it's stats like this, and like our unemployment percentage seen here, that keeps providing the image that Alberta will be A-okay during all of this. Oh, and I can't forget to speak about our tax rates here. Yes, Alberta is the place for Canadians to prosper, to build wealth, to build retirement savings, to earn and to keep most income in their pockets, and to enjoy a standard of living not found anywhere else in this great country. This isn't Alberta realtor rhetoric. No, this is cold hard fact. And due to the housing price gap, we will be singing this song for well over half a decade, if not longer. So to end in the way that I started, could the crash really come to Calgary? My bet continues to be no. Thanks again for watching. Don't forget to subscribe if you haven't already, and please share this with as many people as you can that would see value in this. See you next month.